Well, thank you very much for having me, and thank you so much to Jean and John for the introduction and kind words. It's a pleasure to be here. As John said, I previously was a classical musician and an elementary school teacher, and worked in various fields in law during my law school time, both in criminal justice and working for arts advocacy organizations. After law school, I worked in family law, representing children in Manhattan and Brooklyn Family Court, in custody and visitation cases, as well as abuse and neglect. But I'm here with my sort of law and finance hat on, and the topic is going to be banking in the 21st century, but I want to talk first about where I'm coming from. So, as John mentioned, I am the president of the Modern Money Network. The words modern money are a reference to a quote from Keynes in his treatise on money, where he says that the state comes in as the authority of law that enforces money contracts, but not just enforces money contracts, determines what the things that money contracts have to pay with, and that they have claimed that right. All modern states have claimed that right for about the last 4,000 years, when they claimed the right, so to speak, to re-edit the dictionary. So the word modern here is not sort of 21st century or 20th century modernity, it's sort of 4,000 years of advanced civilization where we go beyond the kind of face-to-face communities of hunter-gatherer societies. And so the question is sort of, what is money in advanced civilization, and what role does it serve? And in this sort of spirit of that secular historical approach, we're trying to look at what the next phase of money is as we enter a sort of world defined by digital technology and social relations that are different to the relations that have existed in prior epochs. So we start by looking at money because it is a framework that is very comprehensive and versatile, in the sense that a lot of economic logic and society is built around the idea that we are not simply engaging in barter or some sort of more advanced version of barter, but we're engaged in a monetary production economy. And that is true not just of the last sort of 400 or 500 years of what we might think of as sort of modern capitalism, but all the way back to the ancient Near East, Mesopotamian civilization, and Egypt and Greece and Rome and things that came after it, where entities were engaged in the pursuit of money for the purposes of then later making more money. So to use a kind of Marxist term that Keynes later borrowed, rather than the logic of the economy being the production of commodities, C, to then get money, to then get more commodities, the logic is one of accumulating money to then sell commodities, to then accumulate more money. And so using that framework, we can look at a range of different social phenomena today and ask sort of what's going on and how can that framework inform where we're coming and where we're going, where we've come from and where we're going. So when we look at money, there is one approach that we try to sort of start with, in addition to this understanding of the state and the role of law even beyond the state, which is a sort of sociological approach, perhaps best captured by Viviana Zeller's work, which is this idea of money having a range of different experiences depending on who uses it and what context it gets used. So the examples that she looks at are things where, for example, people in the mafia might not donate the money that they earn illegally at church on Saturday, because you don't do that with that kind of money, kind of thing. So even though we might think of money as a social technology whose essence is impersonal and fungible, in practice it has a whole range of social connotations that get added to it by people in particular situations, whether that's food stamps all the way through to sort of donation plate money. So on one level there's this sort of idea that the idea that money is a single interchangeable impersonal instrument is an ideological claim. But beyond that, this idea that even more structurally than culturally, there are a hierarchy of different kinds of monies that exist at any point in time. So we think of the money in our pocket being money, but we can also think of bank deposits in your bank account being money. We can think of shadow banking assets as being money. We can think of the bar tab at your local bar being a form of money. So in that sense, it's to sort of be Schumpeterian and credit theory of money and looking at under what conditions forms of credit become circulable in a monetary sense beyond merely the bilateral or even sort of trilateral nature of regular credit. In addition to that, one of the things that my organisation has tried to emphasise and bring together scholars around is the idea that money and financial institutions more broadly are legal institutions. They're legally constructed. So rather than lawyers coming in after the economists and the monetary theorists and the bankers have done all the important stuff, we look at money as something where the legal construction of society, not just property rights, contract law, the constitutional architecture of society, but the actual very legal plumbing of money itself, whether it's the contractual basis of a bank deposit or the tax receivability of a particular kind of instrument that then makes it valuable beyond its sort of basic commodity form. And that framework is one that is relatively underdeveloped. Roy Kreitner, a law professor at Tel Aviv University, pointed out in a 2012 article called The Legal History of Money that if you went to a law professor and said, tell me about the law of marriage or the law of torts, most standard professors would be able to give you a sort of bibliography of where to start and a few anthologies. But if you say, I want to learn about the legal history of money, there isn't really much there. There are a few textbooks, there are a few isolated articles, but there isn't a body of work, there isn't a canon, there isn't a sort of sense in the legal academy that this is a space in which lawyers should be thinking. And not to sort of point fingers too much, but Richard Posner, the sort of law and economics poster child, the most cited legal scholar of the 20th century, wrote an article in 2009 called How I Became a Keynesian, where he said, I had never bothered to read the general theory, Keynes's general theory, up until 2009. And mind you, this is a man who publishes a book a year for 40 years and has probably read 5 books on Himalayan throat singing and didn't bother to read Keynes's general theory because he said it was a work of macroeconomics and law didn't play into macroeconomics. It wasn't relevant to questions of unemployment or inflation and growth, so I didn't think it was relevant. And besides, my friend Gregory Mankiw at the Harvard Economics Department told me that Keynes was outdated and there wasn't really anything that needed to be read from him. But after watching the global financial crisis and the economics profession flounder to sort of explain what happened, I decided that maybe I should go back and read it. And what did I find? It's the best guide we have to the crisis. So this is the founder of the contemporary law and economics movement who didn't bother to read the founding text of macroeconomics because he thought it was irrelevant to his work. That's the state that we are in as a discipline on these issues. And since the 2008 crisis, there has been a sort of revival or renewal of interest in this area, and there are sort of green shoots coming out, but it still remains a disparate and underdeveloped field. So if anybody is looking for research topics, please be welcome to join us. We'd love to have you. The last kind of angle of how we look at money is that in addition to being a social construction legal institution, money has a materiality that is historical. So it matters beyond just the fact that money is legally constructed, that we are in the 21st century and not in ancient Mesopotamia. And to that extent, Paul Volcker's line that perhaps the only useful financial innovation of the latter half of the 20th century was the invention of the ATM has some truth to it in that there is a story of the technological development of monetary and financial instruments and institutions that is separate to, but obviously intertwined with the legal story of the legal architecture of money. So in that sense, we look at money sort of like how Joseph Sumner, who's a lawyer at the Federal Reserve Bank, thinks of it as we can say money is what a payment system does, in addition to being a legal institution. And when we think about that, that brings me into this idea of what we now sort of sexily refer to as fintech. If you look outside, every man and his dog has an initial coin offering, an ICO. All the large financial institutions are scrambling to work out what this kind of technology means for them. Even governments and central banks are starting to get in on the action, albeit predictably late. So this finance ecosystem is broader than simply the cash in your pocket or the bank deposits in your account. it has a whole wide range of services, from insurance through to derivatives through to the prepaid cards that you can get at a convenience store. But particularly of relevance for me is the public finance ecosystem, because it may be obvious to say, well, any kind of financial institution that creates some instrument may have some degree of moneyness as a sort of property of that instrument. But if we stop and think about public finance, there's actually a whole internal ecosystem of public financial instruments that doesn't get treated as such. So to give an example, student debt that gets held by financial institutions and securitized and traded, if that debt is government-backed, in the same way as certain kinds of mortgage loans were government-backed prior to the 2008 crisis, and still are, that instrument has a moneyness to it that renders it closer to the cash in your pocket than to a private financial security. Yet, most people wouldn't think of the student debt market or even the student loan-backed securities market as being a money market per se, even though that's actually really how it functions. So there is this public finance ecosystem that has a range of different dynamics going on that reflect the different agencies and institutions of the government and the different functions for which those instruments were created. And rather than simply just saying this is bad, we should sort of stop using it, or this is inefficient, to sort of use the Buckminster Fuller approach, the important thing is to make it obsolete, to invent a better system, and to sort of point the way forward that simply renders these current inefficiencies or sort of design, historical design features unnecessary. So the space that I'm working on right now is around digital fiat currency, so not Bitcoin, not private blockchain institutions, not the next hot thing that's going to make someone a buck, but the public infrastructure that is going to undergird the public payment system and the public financial system for the next 50 to 100 years, if not more. And so in that space, we have the Bank of England, the Bank of India, the People's Bank of China, the Swedish central bank are all looking to sort of move into digital payments that they control rather than ones that are primarily based in the depository banking layer of the system and then they simply supervise. That's been the approach for most of the 20th century, and they are moving to a point now where, thanks to technological development as well as just the changes in the way that the financial markets work, that they are taking an active responsibility for parts of the retail as well as the wholesale payments and financial infrastructure. So what I'm interested in looking at is how we can design a digital fiat currency unit that will have the maximum versatility and impact that can do all the things that current existing systems do without the necessary, plurality and redundancy of all these institutions. So if you think about back in the late 90s or the early 2000s, you would have to send a text message on the SMS system, then you would call someone on the phone system, then you might send an email on your computer with dial-up. Now you will do it through one 4G network. And that concept of moving a whole range of services that initially seemed disparate into one common platform once the underlying common technology becomes apparent, which is to say in that situation these are all just forms of data transfer across a network, it becomes clear that we don't need to have 6 different types of infrastructures to achieve that. We can achieve it with one once that infrastructure becomes sufficiently powerful. And that's what we're looking at with the digital fiat currency system. So the basic properties that I see as being relevant, I'm happy to talk further about them, is first of all, it's going to be a digital token. It's going to be issued by the government, whether it's the Treasury or the central bank or just the whole consolidated government is largely irrelevant for this point of the analysis. It's going to be tax receivable, and by taxes there, I'm using that term quite broadly to mean any legal liability. So a fee, a fine, court judgment, anything where there's essentially a legal gun to your head saying you have to discharge this obligation, that if this unit can be used in satisfaction of that obligation. So it isn't merely legal tender, even though that may be the obvious place to go, because you can have something that's tax receivable without being legal tender, and vice versa. Well, not so much vice versa, but that direction. Now, and I'll explain this in more detail later, you can have this instrument to have a zero interest rate, like the cash in your pocket, or a positive interest rate. So unlike the cash in your pocket, it can pay interest even while being a cash instrument, just like your checking account can pay interest, but you still use it like cash. And it can have a maturity, in the same way as a savings account at a bank can have a maturity, but you can still essentially use it as like a checking account as long as you can transfer out of it into something that has a more immediacy to its payment processing. So those are the kind of obvious parts. The two parts that are new, or that I want to focus on, which are where I think are the most interesting design and regulatory areas, are a concept that I call superconvertibility, and then the question of whether this is going to be a bearer instrument, which in payments law means whoever's holding it, it's current, versus a intermediary registered account liability. So think of a bank or a bookie where it exists as a liability of some intermediary. So if you and I both have an account at Barclays and we want to pay each other, all that means is that Barclays moves some numbers from one account to another. It doesn't actually need to have any external assets in the same way as a bookie could essentially manage your relationship to your local grocer as long as you both owe the bookie enough money and they're willing to do so. So the superconvertibility concept, what I mean by this, in the same way as I was just talking about with the internet, the idea here is to think of all of these different kinds of government liabilities, things that we would obviously consider as money, things that we would maybe consider as debt, things that maybe we would consider as neither, like a tax credit, and think of them all as a spectrum of government obligations that have a moneyness to them, and think of them as having different properties but sharing an underlying sort of essence as a government liability. So we can look at coins versus notes, for example, and one obvious distinction is that they have a different denomination. Another obvious distinction is that they're issued by different government agencies. So for the purposes of internal government accounting, it matters whether it's issued by the Mint or the Bank of England. For the purposes of someone using it, it doesn't matter. Nobody says, well, this is issued by the Treasury, this is issued by the Bank of England, I don't trust this and I trust that. Right? The same legal kind of guarantees and safety from the perspective of the asset holder apply, even as it matters for the internal government accounting which one's issued by. And then you have other properties, for example, government debt, which from the perspective of money market investors has the highest degree of moneyness, even above cash. If you ask someone who has $100 billion in assets where they store their cash, they're not going to say in £100 notes under the mattress, they're going to say, I store it in Treasury securities. So from the perspective of large institutional investors, government securities are a form of money that has better moneyness for their needs than cash. Of course, if you have $1 billion in Treasury securities and you need to buy a soda from the vending machine, you're probably shit out of luck. So it matters what your needs are and where you fit in the ecosystem in terms of what moneyness properties are most relevant to you. And it matters also from a legal perspective whether these obligations are securitizable and hypothecable. So in the run-up to the global financial crisis, one of the things that you saw was that a Treasury security would be pledged as collateral for a repurchase agreement and then would be further pledged again in a different repurchase agreement. And so you may have a single Treasury security, a single asset, that is used for 5 or 6 transactions. 5 or 6 people claim they hold it for the purposes of their own assets. That isn't the case with a $100 bill. And that legal distinction between the different kinds of government liabilities is a relevant one. So superconvertibility is a way of saying there's a central instrument that is the sort of meta instrument. So in the same way as you need to take $100 in notes and get it converted into coins, or you have your checking account and your savings account, the idea that these are all convertible in some way. That central convertibility hub, whatever that instrument is, has the most superconvertibility is how I think of it. So what this enables us to do is to take all of the existing different instruments and consider them as subcategories of this larger instrument. There is a digital fiat currency instrument, and if it has securitizable properties, then it's a sort of treasury debt version. If it has no maturity and no interest, it's sort of a cash version. If it's used for only small retail payments, it's like a coin. Those are the ways that we can think of these different instruments. So that's the first thing, the idea of superconvertibility being an important design question. The second question is this bearer account versus the bearer instrument versus a registered account. So there's sort of two visions we can see of the future here, and they both kind of exist in parallel and simultaneously. The first vision is we take all of the existing banking system where you have an account at a certain bank, and maybe there's 4 banks in the country, maybe there's 10, maybe it doesn't matter, and you simply put all of those accounts up to the central bank. You say, once upon a time, the central bank didn't have the internal processing power across an entire country to manage every single transaction. Today, it does. Today, you don't need a branch in every town to process every town's transactions. You just need a cell phone tower to a single database. And so the idea there being you give everyone a central bank account, and that becomes their core savings or checking account in the same way as you have a sort of social security savings account. Now, that exists already. That's not a theoretical concept. Ecuador has given every citizen a mobile phone linked account at their central bank. The rollout has been greater or lesser degree successful, depending on who you ask, and the range of uses is still limited. But that model of giving a central bank account to everyone is one that is being considered by the Bank of International Settlements, the central banker's central bank, and has a proof of concept. A more basic, banal version of that is the postal banking system that exists in the UK or Japan. There's no reason to not consider the postal banking system's accounts as essentially being government accounts. In the US, you can have a personal account at the Treasury to hold Treasury securities. So we could think of that like a personal savings account run by the government. So that's one version. I call that a visible ledger system. And the reason it's relevant that it's a visible ledger system is that essentially that intermediary can see everything, right? It's like when you have your privacy settings on Facebook, the one privacy setting you never get to turn off is whether Mark Zuckerberg gets to read everything that you say to everybody. So in the same way, when you have an account at a central bank, the one entity that's going to be able to see everything is a central bank. And that matters if you're a civil libertarian and you care about the ability of an authoritarian regime to turn off the payments platform to entities that it doesn't like, say in the middle of an Arab Spring uprising. So that system, that trusted intermediary system, may be the most efficient in terms of real resource uses and processing costs, but also may incur risks from a political design perspective. The other system, which I call an invisible ledger system, works more like cash. The government issues a certain amount, it knows that it's issued a certain amount and hasn't taken it back yet. So when you pay your taxes, if you paid your taxes in cash and mailed a wad of notes to the bank, they're just going to rip that up and burn it. They don't need your cash, they have a printing press. And it's old and it's probably covered in cocaine, so why would they bother keeping it? So if they need to have more money, they'll just print more money. What the purpose of that tax is there is to destroy that money and to take it out of circulation. And maybe, hopefully take it from people who have too much and not take it from people who have too little. Right? But the idea that the central bank keeps a measure of the outstanding stock of those instruments, but otherwise doesn't monitor who or what is going on with that stock. And that is the idea of a bearer instrument where, from their perspective, whoever turns up and is holding it owns it from our point of view. Now, maybe you'll trace the flows later and you'll work out if that's been laundered, etc. But from the purposes of regular commercial transactions, if you're holding it, it's current, hence the word currency. And that idea is what I call invisible ledger system, and Russia just announced that it's going to be implementing what they call a crypto ruble, which means that if you can prove where the money came from, you pay it the regular rate. If you can't prove where it came from, you can still pay with it, but you incur a 13% discount. So that's one way of dealing with this, is to bake in anonymity but charge a price for it. Historically speaking, taxing a certain kind of currency instrument relative to others has been the surest way to tax that out of existence. So whether that's going to survive remains to be seen. But there is a company that I have been consulting with and running white papers for called eCurrency Mint, and they have developed a protocol. They've been working with about 20 central banks doing the behind-the-scenes stress testing of this, and they just rolled out in Senegal at the beginning of this year. and they'll be rolling out to the rest of the West African Monetary Union as well as other larger central banks in the years to come. And that model is a model where the currency is issued by the government, but the wallet network maintains the payments architecture. And so from the perspective of the wallet system, the only thing it wants to know is that when you spend, you're not being able to double spend. So the analogy or the metaphor that I use here is, imagine that I wanted to transact with John, but we didn't want to have an account at an intermediary, and we didn't want anyone to know who we were and what we were transacting for. So we put on balaclavas, we go up to the payments wallet processor and we say, I've got $15 in my account, he's got $25 in his account, he wants to give me 5, so we'll have 20 each. So rather than transfer 5 from one account to the other, they take my 15, they take his 25, rip them up, like you rip up the notes that you pay your taxes with, and issue 2 brand new $20 bills. It could be $23.50, it could be $107, it doesn't matter because it's digital. We don't have to be stuck in fixed denominations like we did with physical currency notes. So from the perspective of the intermediary, all they've essentially done is give change. And they've given change to 2 people in a way that essentially facilitates a transaction. So from having 15 and 25, we now have 20 and 20. The functional effect is that 5 has been transferred, but there has been no direct transfer and no actual account. So that's the sort of technological source underpinning this idea, but the idea is essentially that you have the ability to do decentralized transactions that don't require the centralized authority to be able to pinpoint who you are and say you can't do that transaction. And you could bundle those up in the same way as the Tor browser allows people to browse the internet in large batches and therefore not be able to see what one particular person is browsing. You could have 10,000 transactions be batched together, and the only thing that would have to be proven is that the amount of currency at the beginning of those transactions is the same as the amount at the end, and that would be approved. So in that world, you can imagine a role for banking that is different from the current role. And the current role of banking, people here are not necessarily coming from a finance background, but what you may have heard in your Econ 101 classes, if you unfortunately had to take one, is the idea that a bank lends out someone else's money. Or maybe they lend out someone else's money, but they get to leverage it by a certain fraction. That is incorrect. The Bank of England has made it very clear in the last couple of years that that's incorrect. They wrote a great paper called Money Creation in the Modern Economy back in about 2014 that lays this out quite clearly. But the truth of the matter is that when a bank extends a loan, it simply marks up its liabilities. In the same way as if you came to me and said, can I get Rohan dollars? And I just issued some Rohan dollars and just recorded that I owe this person however many Rohan dollars I issued. From the bank's perspective, that's how a loan gets made. It extends its own deposits, and it's only if you try to transfer to another bank or get that money out in cash that it has to actually get reserves or get government-issued currency. So this is what I was saying before with a bookie. You know, a bookie doesn't have to cash out until you actually cash out. If you just take your winnings and reinvest in another bet, the bookie can continue to finance that without ever actually dipping into its own pocket of real funds. Now, the only question then is, under what conditions can a regular bank get central bank cash? And the answer is, it can always get central bank cash at the interest rate that central bank is willing to lend. The central bank does not say, we're not going to lend any cash today. If they said that, the financial system would stop working. This is actually what happened to Greece in 2015 when the European Central Bank cut off emergency liquidity assistance, ELA. They said, we're not going to lend you anymore to your banking system. The bank said, well, we can't process transactions then. Because if someone comes to us and asks to get cash out and we don't have enough liquid cash on hand, we won't be able to do that and the transaction's going to fail. And the minute transactions start failing in the banking system, the whole thing starts going under. Which is why the first mandate of almost every central bank in the world is to keep a smooth and orderly payment system functioning, which means providing liquidity as necessary. So it's important, I'll get back to why it's important for banking in a second, that the central bank does not restrict liquidity to the banking system as a matter of course. It only dictates the price at which liquidity is available. So when you talk about banks making loans, one of the issues today is that banks can create loans as necessary according to the capital requirements they have, but when they do so, the deposits that they create are only insured up until a certain amount. Some countries don't have any deposit insurance, some countries have 100,000 or 150,000 pounds or dollars or whatever it is. But what that means is if you are a money manager with $100 billion, you can't put $100 billion in cash in one of these accounts and it be safe. There are legal limits to the safety of a bank account, and as a result they're forced to look to other forms of assets like government securities to store their cash. So the limited deposit insurance of the banking system today is a serious design flaw. And everybody in the financial regulatory system knows that it's a design flaw because when the shit hits the fan, they provide that extra insurance. They just do it after the fact and they do it de facto. And it's a problem that it's de facto, not de jure, because it changes how these money managers are able to engage in their fiduciary, discharge their fiduciary obligations. So the vision in this digital fiat currency world of banks is acknowledging the fact that when a bank extends deposits, and those deposits are explicitly backed up to a certain amount and implicitly backed for the rest, and that the whole payment system is ultimately backed by the central bank, that what they are is, as Robert Hockett and Sally Omarova at Cornell Law School describe, franchisees of the central bank. They are extending government credit, the full faith and credit of the sovereign, as an intermediary. They are not simply taking savers' deposits and issuing it out to borrowers. They are channeling new purchasing power backed by the state, and in doing so are exercising a sort of public-private partnership structure in pursuit of what MILC would call the capital development of the economy. So in light of that, if you have a financial payments infrastructure that the government is already providing, what role is left for these banks? The answer is credit analysis. It's still important that banks are assessing whether you are a worthy credit risk to give a loan to, even if they aren't the ones managing the payments rails underneath. It changes how the public perceives these institutions to think of them as essentially mini fiscal agents. Every time a bank makes a loan, it's essentially creating new money, and every time a loan gets repaid, it's essentially destroying that money. In the same way as if I issue IOUs and then you come and redeem them, I rip them up. They go away. My balance sheet shrinks. So if I issue a loan to you, I have your loan as an asset, you have my IOUs as your asset. When you pay back the loan gets destroyed, the IOUs get destroyed. That's how a bank loan works today. And the idea here is that a bank would essentially be a franchisee of the government's liquidity explicitly, and then in doing so you would be able to assess whether or not that social function was worthwhile relative to other political priorities. So if there is a spending need for, say, public healthcare or green energy investment, and the concern is that this will overheat the economy, this will place demands on scarce resources. What this framework, in addition to just being a more robust financial architecture, makes very clear is that there are potential trade-offs between more public spending and more private financial investment, and that those trade-offs should be part of the conversation explicitly. The last thing about this is that this makes clear the nature of money and of banking in a way that is currently obscured by the way that we think of banks working today. And so in that respect, going back to my organization's mission, this is a way to allow a much more clear and honest public discussion about the way that money and finance works, and in doing so, hopefully get past some of the harmful myths that currently justify bad economic management, and in doing so lead to political breakdown. So the vision here is that the underlying payments technology changes will open up ways to make banking, even as it currently work better, but that the secondary effects of changing the way that banking looks can have a feedback into the way that policy is made. So I'll stop there and have any questions if there is any. Thanks.
We've got like half an hour, so can I just take the prerogative to ask the first question? frame a bit. Okay, so taking up off your last point, the nature of money or the nature of banking. Here's as what I understand intimated behind your talk, right? And I just wonder how you would, if that's right, or if how you would riff off of that, or just, you know what I mean? Okay. So the first is that money is political, meaning at least that the state makes money. It doesn't come out of bargain or barter. Like the state actually makes money, and in a fiat currency, right, where taxes require that you pay the state in that currency, you are a debt is created and an obligation is created that's backed up by guns and stuff. So the only purpose of taxes is not to give the state money, right? Not for the state to raise revenue, because it could always print money. It's to create a sense of political obligation, a community, right? And so that part, and then so that says something about taxation, that says something about money. And the other side is, if the state's printing money, that's another word for saying spending. So when the state, it's an IOU, where if the state spends, right, then, right, that kicks off this. So I was wondering if you could, if that's right, if that's underneath it, how would you talk more about those?
Yeah, sure. So the first example, the best way to think of this is, or perhaps the most crude way to make this point is to think about colonial situations where there are certain societies that are pre-monetary or non-monetary, if you don't want to be teleological about it, where they are then violently confronted with a monetary regime that forces them to start engaging in a monetary production economy. So there's a great article by Matthew Forstater called Marx's Primitive Accumulation and Money, I think the case of primitive accumulation in colonial Africa. And the point there is that when European colonists in Africa came across certain communities where the community was not a monetary production economy, there may be a gift economy or a subsistence economy or something, but they wanted those colonized peoples to engage in labor for them, picking rubber. They would initially offered them money and said, you get to buy stuff, you get to be part of the Great British Empire, and they told them politely that they're not interested, and they sort of came back and said, let me rephrase, we got a gun to your head and we're going to stand there and watch you pick the rubber. And what they realized was that was incredibly inefficient and took a lot of time and energy to monitor, and so they realized that the easiest way to do this was simply to threaten to burn down their hut or burn down their homes or kill them, to put a head tax or a hut tax payable only in British pounds or British shillings. And suddenly, these entities that were not unemployed, if the word unemployment means looking for money and not being able to access it, suddenly went from being in a state of not being unemployed to being unemployed. They said, well, how the hell are we going to earn money? We're going to have our hut burned down, we're going to kill us. He said, funny you mentioned that. There's a rubber factory down the road that'll pay you the shillings. So they framed this rhetorically as, you're contributing to the public coffers. Now you're a subject of the crown, you have to do your part to contribute, we need you to pay your taxes. But of course, they issued the tax credits. They issued the tokens that were being used to pay the credits. So they didn't need to get the tax credits from this community. What they needed was this community to do work in exchange for those tax credits. So it was the real labor that they provided in order to get the money to pay the taxes that was the relevant part from the sovereign's perspective. And this is historically the way that money has worked. There has been some sovereign entity, maybe a warlord, where the warlord has an army, and the army has to provide, you tax a population, say you have to provide 1 month's of military service, and then over time you give that army a series of tokens and you tax a conquered population, and the conquered population has to do whatever the army wants to get those tokens, whether it's provide, booze or prostitution or farming or whatever. And so by imposing the tax, you force them to do whatever is required to earn the means of settling the tax. That's a very sort of crude, violent way of thinking of it, but it's a pretty crude and violent system. And the other way that this happens is through enclosure. So if you're in Britain and then there's farming land that was previously commonsed and then gets enclosed, suddenly you are not able to subsist without working for some entity. And that entity says, okay, if you do this work for me, I'll give you these tokens, and you can use those tokens to then pay your rent. So whether it's a proactive tax or simply a passive enclosure of the means of subsistence, either way is sufficient to drive people into the monetary production economy. And so the second point about spending, yes, basically when I say print money, obviously if you just printed $1 trillion and put it under your mattress, it wouldn't do anything. So money only is relevant to the extent that it's in circulation. And this goes to this exact point. What matters from the perspective of the sovereign is what you have to do to earn it. So if you have a government that is willing to hire every person in society to do some sort of socially beneficial work, however defined, hopefully not defined as join the army and kill people, then the price of money is whatever you have to do to earn it. So if you offered people a guaranteed job at a minimum wage of $15 an hour, then $1 would be worth, at the very least, 4 minutes of people's time. Or at the very most 4 minutes of people's time, depending on who you are. So the relationship between real production and monetary income is in that ability to set the prices at which money is injected. And it's important to note that this is true even if you, so to speak, borrow money. So when the government borrows, what the government is doing is issuing a treasury security. When a government prints money, what it's doing is issuing a note. What's the difference between a £100 note and a £100 treasury security? That goes back to what I was saying before about the different properties of different instruments. So, as central bankers have begrudgingly acknowledged over the last decade, if you have a zero interest treasury security, so recently, for example, Ireland just issued a treasury auction where they actually issued it at -1%, which means people were paying Ireland for the privilege of lending them money, which kind of sounds crazy until you realize that it's not about lending money at all, it's about wanting access to a safe investment asset. People were willing to pay Ireland because it was valuable to them to hold Irish bonds as a form of cash, rather than whatever else they would have been holding their money in. So with the idea of government borrowing is really simply financing their spending by issuing a different kind of instrument, whether it has a positive duration, with 3 months or 6 months, or it has no duration, like the cash in your pocket. Whether it has a positive interest rate, which some securities do, or it doesn't have a positive interest rate like the cash in your pocket. Now, reserves at the central bank for most of the 20th century didn't pay interest. They were considered a digital version of cash. In the last 10 years, in the US and in other countries even before that, reserves at central banks now pay interest. So what's the difference between interest-paying cash and an interest-paying 3 months treasury bond? Well, the obvious first answer is the maturity. 3 months versus nothing. But if the central bank is standing there saying, anybody that wants to sell us 3 month treasury bonds will buy immediately and give you cash, then the idea that that maturity means that it's not liquid is stupid. It doesn't make any sense. It's like saying I've got a savings account, but I can't spend out of it, but I could always simply transfer it to a checking account 5 seconds before I needed to spend. No one would say, I'm constrained by the fact that my savings account is time restricted, because you just simply change it into a different kind of instrument and then spend it. And it's the same with treasury securities. If you can always transfer treasury securities into cash, the maturity isn't real maturity. What it really is about setting an interest rate curve over a long range of assets that they want to use as a benchmark rate for other financial instruments. So to give an example about that, Steve Mnuchin, the US Treasury Secretary, recently floated the idea of issuing 50-year treasury bonds. Currently, the longest maturity duration in the US is 30 years. In the UK, they actually have something called a perpetual bond, a consul, which you never pay back the principal. So what the hell kind of debt is that when it never gets paid back? Right? It kind of goes beyond the idea of what we normally think of as debt. But right now, there is no 50-year rate, interest rate. If you started issuing 50-year bonds, there would be a 50-year rate. Similarly, if you simply stopped issuing 30-year bonds, there wouldn't be a 30-year rate. And in the past, the central bank, the Federal Reserve, wanted to keep the 30-year rate at a certain rate, and it just said, okay, we'll buy up all of the bonds at that rate. And you know what? The rate stayed exactly at that rate for as long as they wanted to, because only an idiot tries to fight against the Federal Reserve when it comes to shorting treasury bonds, right? People in Japan have tried to do this for the last decade. Oh, the Japanese bonds are going to go up, they're going to go up. The Bank of Japan said, no, they're not. Everybody that tried to fight against them lost a hell of a lot of money and looked like an idiot. So when you have an infinity sign next to your bank account, which is what a central bank has, you can set the price because you simply just stand willing to purchase everything that goes above that price.
Ira, very fascinating, I found. Just linking to one of your last points on money as a store of value, and the system you have been discussing, how do you, or what processes determine the value of money, so the intrinsic value? So what is the value that we have in our property? And this also, to your point on what you mentioned about Ecuador, I mean, I happened to travel to Ecuador last summer, and I was surprised that an export-led economy was employing foreign currency as a means of exchange. So,
yeah, okay. So the first question, what gives money value? I mean, first of all, there are monies, even in a single unit of account, right? In Britain, there isn't just money. There's the cash in your pocket. There are the bank deposits that you have in your bank account. There are the treasury securities that the money managers use. There are the student debt assets that the hedge fund guys are investing in. There are the mortgages that the banks are lending that they then sell to other entities. So there are all kinds of monies. Now, what gives government currency its value? I like to use the example with Monopoly. You know, if you play Monopoly early on in the game, you get the get out of jail free card, and you don't want to be in jail, right? Early on in the game. You want to get as many properties as you can. So how much is that get out of jail free card worth? Well, if getting out of jail, you have to pay $50, you maybe pay up to like $49, right? You're not going to pay $50 because you'll just give the $50 to the bank. So the get out of jail free card is worth almost $50. Later on in the game, when you want to be in jail, because God forbid you land on a hotel, how much is that get out of jail free card worth? $0. So the value of a tax credit is whatever the value of not being taxed is. Right? Gary Becker, God rest his soul, used to sort of say, I can park in a handicap spot if I want, as long as I'm willing to pay the fee, the fine, right? So in that situation, the value of $1 is how much I want to park in a handicap spot. So when it comes to money more broadly, this is a sort of core value I'm talking about. Now on top of that, there's private liquidity. There might be reasons why it's more convenient to store your money in one thing or another, but to sort of use the old adage, there's only two things in life that are certain, death and taxes. You know, banks come and go, private equity comes and goes, stocks come and go, but you're going to have to pay your damn taxes at some point in the future. And as long as you can trust that other people are going to have to pay their taxes, that is to say, as long as you can trust the state isn't going to fail anytime soon, which they do, but not always, then the tax credit's going to continue to have some sort of value. Beyond that, to go into this concept of the hierarchy of monies that I was talking about earlier, that Hyman Minsky and Perry Merling and Daniela Gabor at Bristol talk about, the idea there is the liability of some entity that isn't the government is likely to have a higher degree of moneyness based on how likely it is to be safe. So that is to say, how likely it is to get government support in times of crisis. So money market fund shares claimed that they were safe. They claimed that they would never drop below $1. When they started dropping below $1, people lost a lot of faith in those instruments until the government stepped in and backed them. Bank deposits. For a very long part of history, before Walter Bagehot over here decided that we needed to have deposit insurance and a lender of last resort at the central bank, the value of bank deposits would fluctuate very wildly depending on how safe you thought that particular bank was. Once they said, yeah, we'll back every bank up to a certain amount, no run on the bank. Right? Deposits didn't lose value in the 08 crisis, largely speaking. So with regards to Ecuador in particular, a dollarized economy, I mean, there's a range of reasons why a country might have a dollarized economy, to do with the lack of economic and monetary sovereignty, to do with the history of colonialism, to do with, pressure placed on it by foreign institutions operating on bad logic. But the story of, I believe it was Brazil, had moved off a dollarized economy, and one of the ways that they did that was they set up a parallel unit of account, and they started pricing things in both, even as they remained on a dollarized system. And over time, that psychologically got people to see that there was a fixed exchange rate between these two systems. And eventually they started issuing their own unit of account again, their own currency again, and that psychological link was maintained. Other countries that have attempted to de-dollarize haven't necessarily been able to maintain some sort of stable account exchange rate at the start, and as a result, people haven't had faith in that currency, particularly when the country has to export a lot to be able to maintain real terms of trade to import basic goods and services. So, once you're in a dollarized situation, it's a really rough place to get out of, and the fact that Ecuador is offering these central bank issued units that can be payable in taxes. Right now they are dollar denominated, but they don't have to be in the future. And ultimately, as long as there is a stable tax base locally, there is some value that can be given here. And the example I use for that is it doesn't even have to be a federal government to issue something that can have value as a tax credit. And if you think about it, I lived in New York City for about 8 years, the New York City Metro card. Now if you could buy groceries with the Metro card, right, New York City could issue Metro points. It doesn't need to tax anyone to get Metro points in the same way as the NFL games don't need to tax the prior game to get the points to give the players this time. It's not, nobody cancels a basketball game because the scoreboard has run out of points. So you don't, if you have a metro system and you know that there's always going to be demand for people to use that metro system, I don't think the New York subway is going to stop running anytime soon, even if it just gets slower and slower, the metro tickets are going to have some value above zero, and people are going to pay for that. So you could theoretically run a whole monetary system based around the fact that these metro cards are payable in your subway tax. Now, there's a limit to how many you can issue before people say, I don't need any more of these, or there's a better thing to store value in, etc. But who knows how large that is, because you've got 8 million people using that subway system on a pretty regular basis. There's the time horizon for the value of those tokens is going to be pretty large. Nobody is worried about metro cards losing value on a day-to-day basis. You had a question?
Yes, I did. So, okay, from what I gather, the centralized thing, not a good thing because then the government can be authoritarian and choose la la la. And then we go back to the intermediary. What's in it for the intermediary? Will there be charges? How will that work? One.
Yeah, so 2 things. I think you can have some value to these intermediaries, but the issue is whether it's the totalizing system, right? So right now, the way that email works, most people have an account with Gmail or Hotmail or Office or something, but you can set up your own email server. Hopefully you don't do it before you run for president, but you can set up an email server at home, and that will work on the same email network as these huge, large conglomerates will work. So theoretically, and in practice, some people do, have the ability to maintain your own email system even as that system interacts with these large players. So with intermediary-based system, you could have 90% of transactions in society go through this, but have some space for 10% of transactions to still be able to be done through some alternative anonymous network. Or alternatively, you could have a system where there is an intermediary that most people use in a wallet network, but other people can run their own wallets in theory. Now the question of why a private intermediary would want to do this, well, one is you could charge fees, right?
Yeah, it's not fun though.
Not fun, it's not great, maybe we don't need them at all. Maybe we'll agree to have them for a short period of time as a sort of, bargaining transitional concession so that they're not in our way, and then eventually make them obsolete. But on one hand, you could download most songs and TV shows for free online, yet most people pay $10 for the convenience of Netflix. So if you are offering a front-ended API layer, an app, a wallet app, that is slightly more convenient and user-friendly than the one that you get for free. You get your bare metals, your bare bones kind of account that you can have with a free payment system, or you can pay $10 and get all the fancy doodads, and it'll tell you what your heart rate is and how many steps you walked this month or something. That could be a reason why people will do it. Another option is they get your data and they get to create a customer profile that then they sell to other people. Or I'm not too worried that the intermediaries are going to find ways to make money, but the question of whether they need to be included at all is a good one. And I think the postal banking system seems to work pretty well at the moment. Nobody seems to have a problem with the postal banking system being able to make payments and things. So the question of whether you need to have those private intermediaries be able to run the wallets, or whether the wallet system can be run by a public system, or even just something that you give every citizen. You could give every citizen a server that costs $10, plug it in the wall, and that could run your wallet for you, and those could talk to each other in a mesh network that would be completely, technically possible under the same logic. At this point, the aim is to separate the back-of-house transaction processing from the front-end consumer-facing side, because it's the back-end wallet network that needs to have the integrity, and you can allow sort of private innovation at the front end if they want to do that. If that makes sense.
I've got 2 more questions, but
Well, maybe I can batch some. Do you want me to just get a bunch together and then ask them?
Is that cool? If we
Fine with me.
like go around the room and bring the question. We had someone in the back and was just snake. Is that cool?
So, sorry,
Yeah, go for it.
I mean, yeah, maybe diving off these sort of last questions. So you mentioned the question sort of the political design perspective, and at least the way you were framing it before, it seemed I could sort of understand the political or the rough politics of why you want to make this sort of move. But now you're talking about private entities using this wallet system, or this can be so maybe on a sort of structural level. What is political design? How fixed are these political designs?
Yeah.
And what do we need to be worried about? I mean, we started off with the state, but now we're talking about
Yeah, okay, so I know I said batching, but I'll answer this in particular. So there's two bits of context that are relevant here. The first one is, as I was saying, because banks are going to still have a role in credit underwriting, or private, financial intermediaries, it could be public banks, it doesn't really matter, but because banks doing banking, separate from banks doing payments, is still going to have a role, it may be that banks are going to offer you credit services or stock market speculation services, and you get an account to go with it. And so the bank just benefits from keeping all this stuff under the same roof, right? In the same way as maybe offering you Google Drive isn't the major reason why they do it, but they do it because then they have this whole ecosystem that they keep you within. So on one hand, that's one of the reasons why this might be appealing to entities. The other thing is the context in which the current e-currency company that I've been consulting with is working in is in the developing nations context where mobile money operators don't want to be banks. They are essentially telecom companies. They run data networks. So they have the telecom infrastructure in a place that doesn't have the telecom infrastructure. I'm a pretty lefty progressive person. I'm down for public infrastructure, but the fact of the matter is that Haiti's telecom infrastructure is privately owned. So if you want to have a system where everyone in Haiti can have a public bank account, short of storming the barricades and socializing that and trying to run that tomorrow, the way to do that is to say, okay, look, you run the data network, we will put a public payments infrastructure on top of that, and you can run the front end and tie it in. Now, it's not my ideal situation again, but it really depends on the context you're in. And a lot of those payments intermediaries, whether they're in Kenya or other places, don't want to become banks. They don't want to deal with all the legal and regulatory challenges of underwriting and working out what kinds of loans should be made and whether you're a good credit risk. They just want to trade the equivalent of piggy bank cash. Right? They want to, you have $10 in your account, you spend $5, it goes over here, and they want that to be safe. They don't want that to be based on bank deposit insurance limits that could cause problems for them if the bank goes under, because those are countries where banks do go under. So they don't want to have a situation where the underlying currency that they're trading is sort of fluctuating wildly in value. They want that to be safe so that they can just move the packets around and run that data network. Does that make sense? Maybe not.
I also have like 3 more questions, so maybe it's best.
Let's go around. Sorry. Yeah.
Let's grab a few.
Yeah, okay.
Is that cool?
Yeah.
We have seen obviously financial crisis historically. 1929, then we had different cases obviously in South America, Argentina. In 1929 in Europe, we had the Second World War because of that.
Yeah.
And then obviously 2008 and others that have not been so famous.
Yeah.
Everything started in the States in 2008 because I think it was Lehman Brothers, and there was another case of the Ponzi scheme, the name that escapes me now.
Bernie Madoff?
Yeah, Bernie Madoff served 100 years in prison. And obviously we paid all the consequences in Europe. What is it that can be done if it's something that it can be foreseeable in the future to tackle the problem? Because obviously banks and financial institutions are not just banks, not just places where people go there and ask for money and borrow, but became investment banks.
Yeah.
That's why they failed.
Yeah.
The question is, who is responsible for, in a way, the crisis, or is it a government issue? But if we say that it's a government, obviously the government has power on the financial institution, it would become a dictatorship. Or because in the States in the 80s they lift all the regulamentations on the banking system. What is it that can be done? For example, in Europe, banks cannot save a company, because in Italy, for example, you cannot save a company that is failing for bankruptcy. So what is it that can be done even in the future?
Let's get a few more.
Right. Just adding to that, you haven't mentioned the global financial crisis, and you did mention that Russia has developed a system where you bring in money and deposit in the banks and prove where the source of the money. You don't have to pay so much tax, and if you can't prove, then you would have to pay a certain, probably a higher rate of tax. My question is, how does that fit into the global financial system, taking into consideration that if you take the 2008 crisis, Lehman Brothers, as you just mentioned, and a few others were indicted for financial crimes and all this stuff. So how does this fit into the global financial system?
Yeah. Okay.
On that point, regarding the Russian
Crypto ruble.
the crypto ruble, with the 13% discount, that matches directly onto the Russian flat rate of income tax. So is it a way of trying to weasel out tax avoidance through this? Yeah.
Anyone else?
Another colleague on that. I wanted to ask, what role do you see for cryptocurrencies in the 21st century?
Anyone else? Okay, cool. So the first question about the crisis. So yeah, what I was talking about with banking, I should have clarified, I'm talking about commercial banking. This is the old Jimmy Stewart vanilla depository institution banking, not investment banking. Obviously the distinction between the two is largely a bit blurred and is largely non-existent today. But the person I think to start with here, and I'm heavily informed by, is MILC. And what he talked about was capitalism and financial systems in general have an inherent tendency towards crisis. So one of the reasons for that is that the investment is based on expectations of future profit. As investment is going well, people's expectations get higher and higher, and so there's an inherent tendency to become more, so to speak, irrational and exuberant towards some sort of higher return until that becomes unfeasible. And one of the things that you see as a result of that is a degradation of people's balance sheets as they finance their positions in an ever more risky way. So you start with hedge financing, then you move to speculative financing, where you're essentially borrowing under the assumption that you'll get future profits rather than simply on the assets you have, and then eventually you're borrowing to pay the interest on your existing debts on the assumption that eventually it's all going to pay off and then it collapses. So MILC's point, first of all, and this is a point that a number of people in my network agree with, and I agree with, is that the hard lesson of banking regulatory history is the liability side of the balance sheet is not the place to exert market discipline. This is a Warren Mose line. What that means is banks, when they issue deposits, when they make loans, when the going is good, that process cannot be unwound in the moment of crisis by saying, tough luck, eat the loss. Because what happens socially as a result of that is huge pain and damage. This is why we had deposit insurance in the first place. So what deposit insurance and the lender of last resort that Walter Bagehot kind of developed, the idea here was liquidity, being able to keep the financial system afloat even as you resolve the reasons why it happened and hold people accountable, etc., has its own intrinsic social value. So what MILC's vision was, what we need to be able to regulate the whole financial system is to take the logic of deposit insurance and lender of last resort and apply it to the whole suite of financial instruments. It sounds on one level like this is simply letting banks socialize risk and take the profit, etc. But what this is really saying that the way to exert discipline and accountability on those entities is not to jam up the whole financial system in that moment of crisis. And even people like Timothy Geithner, who I have no respect and time for, was right in this in the middle of the oil crisis, where he said you can throw a wall of liquidity at the problem and at least avoid the immediate contagion of the fire. And so what MILC's proposal was essentially almost like a shopping list of every financial asset out there and saying you will get liquidity on a discount basis if you pledge these assets at the central bank, because we've allowed you to create them in the first place. We said that at the very basic level these things have some right to exist, and at the point at which the whole thing starts to collapse you should be able to liquefy them. So what I didn't mention before in my talk was, once you make banks explicitly franchisees of the public full faith and credit that they already implicitly are, and you don't rely on this sort of de facto limit of deposit insurance, a de jure limit of deposit insurance that doesn't actually happen in practice. What you do focus instead on is the asset side. So you start saying, what kinds of loans are banks even allowed to make? What kinds of derivative contracts are they even allowed to make? So your question of, is this a totalitarian system? I mean, there have been public banking systems around the world that haven't dissolved into totalitarianism. There have been private banking systems that are pretty cronyistic, even once you accept that they're ultimately going to get government support. So I don't think this is a matter of saying one is socialism and one isn't. I think it's a matter of saying the hard reality is that financial systems are ultimately socially backed, and how do we design a system that is explicit about those risks and socialized benefits, and then as a result of those commitments, then holds the financial system accountable to social pressures in the right way. And so one way that you can do that to an extent, which I'm a big proponent of, is as much as possible insulate real economic activity that's socially valuable from the vagaries of the financial investment cycle.
Is it possible?
So one thing that Reimagining proposed, for example, was a government employer of last resort. Another word of saying a job guarantee. The idea there is, in the same way as banks get a lender of last resort, the government can say anyone that is unemployed, that the private sector has not wanted to employ, can come and get a job. So in good times, very few people are going to turn up and ask for a job. In bad times, a lot of people are going to turn up. So it's inherently counter-cyclical. And what that means is no matter what happens with the financial crises, at the very least, it's not going to cause widespread unemployment.
Because of the assets?
No, because at the point at which they start shedding workers, those workers will be able to go get alternative for the jobs. So it's a sort of basic Keynesian idea taken to the next level when looked at through the lens of financial cycles, as well as just the sort of underlying industrial business cycle. So in regards to the Russian banking system, yes. I mean, first of all, it's not that they pay tax on depositing money with a bank. It's that they have a crypto wallet, and when they make a transaction to another crypto wallet, if that transaction can verify where the money previously came from, it's done with no discount, and if they can't, it's done with the discount. So it's not about depositing in with an intermediary, it's the sort of transaction costs associated with making a particular payment. And yeah, it is related to income tax. The idea is to avoid dark money and to sort of avoid the point is to say, look, we can't ascertain where cash comes from, and right now the reason why we don't have a whole black market economy, well, we do have a whole black market economy, but the reason we don't have it so bad is because outside of fruit and veggie shops and stuff, there's a limited range of places in which you're going to use cash on a day-to-day basis. Of course, once we create a digital payment system where it's equally possible to use this digital cash as it is to use the digital registered account at the central bank or whatever, or your regular bank account, suddenly maybe a whole range of activities that were previously not feasible to use cash for may be feasible to use cash for, and we have to find some way to prevent, suddenly there being billion-dollar transactions in cash that would have required, James Bond-style suitcases and
Definitely
things.
see that happening.
Yeah, so I'm not a big fan necessarily of that because, as I said, and Rebecca Spang, the historian of money, has been pretty clear on this. This is exactly how you tax certain kinds of instruments out of existence. When you take American constitutional law, one of the first cases you look at was the attempts to tax state banknotes in order to make them undesirable as a form of money relative to federal monetary system. So that's there is a real tension here between how you preserve some sort of anonymous, decentralized cash-like payments infrastructure while not opening the floodgates to $1 trillion of black money pools. And that's not an easy answer. My personal view on that is, however we continue to play the cat and mouse game of cops and robbers and freedom and security and all those kinds of things, that we should be at least making sure the technological layer is done. So cash, you can put $1 billion of cash into a few suitcases if you want to. You'll be violating laws that say you can't take $10,000 across state lines without declaring it. But that's a legal layer, and that requires police to get a search warrant and to do all the kinds of things that they do. That's not like the cash is going to start beeping the minute you walk over the Mexican border, right? If the cash started doing that, that would be very unsafe to use cash for any politically subversive activity because they could simply just change the code in which it starts beeping, and then you'd be screwed. And in terms of gold being done, this question of how does this play into the global financial system? If only those banks had been indicted the way that they should have been. And one of the issues is that there isn't a clear set of principles under which banks are allowed to take on new kinds of risks versus not. So by shifting the focus to the asset side and saying what really matters is whether we let you create these things in the first place. So this last 20 years of regulatory theory has been, they know better than us. They're very sophisticated. They know a lot of math, and we kind of are dumb regulators. So let's just trust them to do things, and they're probably going to get it right because, hey, if they get it wrong, it'll be on them, and let's trust their self-interest. That's been the general theory, and people like Larry Summers in the US have been pretty fierce advocates for deregulating commodity futures and derivatives markets under the guise that it is those financial actors that know best whether these things should exist. I think it's quite reasonable to say that a more desirable model would be like the way that the Food and Drug Administration, the FDA, works in the US, where if you want to start issuing a new kind of drug, you have to actually show that it has some social value and it's gone through the right kinds of stress tests. There may be some intermediary way of allowing sort of sandboxes, where like they're doing now with crypto technology, where you can sort of have a sort of safe space to experiment within without letting that necessarily bleed into broader systemic contagion. But broadly speaking, I think that the shift needs to be over to what kinds of financial contracts and assets are going to be recognised and declared legally valid, rather than allowing contracts to just be created under the presumption of freedom of contract being always and everywhere a good thing, and then dealing with the repercussions later when it turns out they were actually systemically important and risky. The last question about cryptocurrencies, I mean, first of all, this question of what a cryptocurrency is, there are different definitions. If you're talking about a form of payments technology that is decentralized, potentially obscures the user or can potentially hide the transaction, there are benefits for that even if they're privately issued. I think, the word money laundering has a negative connotation, but it doesn't have to. One person's money laundering is another person's economic freedom, and the question of whether or not people can engage in certain kinds of transactions that aren't approved by the state is one that we may have a different view if we're coming from a place where we don't feel our freedom is threatened versus one that we feel like it is. And what you're seeing now in China, and you're going to see increasingly in the US, is a system where you have a score that is a measure both of your economic credit rating but also your political obedience, and whether or not anybody in your neighborhood has dogged you into the authorities for saying subversive things. And if you have a bad score, maybe you can't get access to certain kinds of services and things anymore. So the ability to be able to, transact and pay for things without the system knowing who you are necessarily is one that may be quite important, even if it comes with other downsides. In terms of its value, this goes back to the hierarchy question. So, if I'm in debt to a bookie or to the mafia in my neighborhood, the mafia's IOUs are going to be worth something to me because I can trade those IOUs in for not having my legs broken. Now, if you're living halfway across the country and you don't know anyone in that suburb, then maybe those IOUs aren't worthwhile to you. So although government liabilities exist at sort of the top of the hierarchy because, everybody has death and taxes to deal with existentially, other forms of private liabilities, bank deposits are pretty universally accepted because there is a one-to-one par guarantee between bank deposits and government currency. Money market fund liabilities or asset-backed commercial paper that's owned by a bank holding company that has a commercial bank, can fold back up into the bank deposit, so it can fold up the hierarchy. So some forms of cryptocurrency assets that are issued by entities that are systemically important or politically powerful or somehow connected into the financial system that goes up to the government might have inherent value. Others may be valuable only as a form of masking transaction, so that you could hold your money in cash or bank deposits right up until the point you want to spend, filter them through some sort of anonymous transaction payment system, and then filter them back out on the other side or something.
So we have more questions, but why don't we do that over wine? Is that good idea? All right, so Kara, John, Ian, thank you so much, and Rohan, especially you.